Well, things are really moving on our Bitcoin versus gold contest for 2025. Right now, more than half the entries are kind of out of the money, but I think we're in for much more volatility in both Bitcoin and gold before we get to December 31st. The Mises Institute is hosting the Libertarian Scholars Conference and the Austrian Economics Research Conference next weekend. The major lectures will be live streamed, so put that on your calendar. And if you are coming to either or both of the conferences, be sure to look me up and say hello. Hello, and welcome to another episode of the Minor Issues Podcast. I'm Mark Thornton at the Mises Institute. In this week's episode, I'm using an interview I very recently did with Scott Horton on the precarious state of the U.S. economy. Scott is an important libertarian, and his show focuses on topics of foreign policy, international conflict, war, and peace. Scott has me on occasionally to cover topics like the war on drugs or the Austrian business cycle theory. I highly recommend keeping abreast of these issues by becoming a regular listener. In this interview, I was asked about the looming recession and economic crisis, the Fed's likely response, the place of tariffs, and exactly how the crisis will play out in individual markets, especially real estate, as well as some unique opportunities.
Hey, you guys, on the line once again for the first time in way too long, I've got the great Mark Thornton from the Ludwig von Mises Institute, where they practice Austrian economics. And he's written some books, including The Economics of Prohibition and Tariffs, Blockades, and Inflation, The Economics of the Civil War. Welcome back to the show. How you doing?
Hey, Scott, I'm doing great. It's great to be back on the program, and congratulations on your book.
Thank you very much. Appreciate that. And very happy to have you back on the show here. We've got important things to talk about, but way too many of them. In fact, I'm going to have to really try to narrow it down. There are two things I really want to pick your brain about today. And the first one is interest rates, and the second one is tariffs. And so I'm very interested, as you know, not interested enough to really do the hard work on it, but to have you on the show over and over again over the years to ask you about it. Austrian business cycle theory. Not only do I hate inflation, but I hate the way inflation booms and busts the economy all the time. And that's the thing that the Austrians are so right on that nobody else seems to pick up on very well. But so I have all kinds of questions about our current situation with the monetary system, the way it is, and all of that. And I guess maybe a good way to start this conversation off would be that there was talk about bringing Ron Paul in to audit the Fed. And then someone even said, hey, maybe you should make him the chair of the Fed. And I thought, oh, well, Donald Trump's not going to like the sound of that, because Ron Paul is a hard money guy and Donald Trump is a real estate investor who's made it clear that he likes interest rates good and low. And in fact, I think he's even sort of implied that maybe he just nationalized the Fed and set the interest rates himself if they wanted to keep them too high compared to what he wanted, which was actually how I was sold the central bank in the first place when I was a kid. I was told that, well, the Congress will just always vote to inflate and never do the responsible thing. And so that's why you need this semi-independent central bank to take the punch bowl away at the party and all of that kind of thing. So anyway, I'm very interested in how you assess the economy now in terms of where we are in that boom bust cycle as it repeats, and what you think about Trump's preferences for his monetary policy, especially just as his second administration is starting off here.
Wow, it would be great to have Ron Paul in charge of the Fed. That would be ideal at this time and place, or any time and place. He would get rid of it just as quickly as possible. Scott, I thought that the economy was going to turn into a correction, recession, and eventually a crisis in the last quarter of 2024. And that didn't really materialize. And then when Trump was elected, the markets got a lift. Business people got a temporary optimistic lift, and everything looked very good for a while there. And my prediction failed, basically. But I think that today, I think we can see some clear signs that things are turning for the worst. That the stock market, which has been very lackluster and has turned down, is a sign of things to come. That the NASDAQ 100, which is the leading edge, all of the artificial intelligence and the high technology stocks, which led the market up. And believe me, this has been a bull market that is unbelievable. I mean, it's been up basically hundreds of percentages since the great financial crisis, with an interlude during COVID, but basically up, up, and up. And, now we see that the tech stocks are not doing well, and that there's some fundamental reasons why they're not going to reaccelerate. And also the financials and healthcare and a bunch of other things. So stock markets are leading edge. They tell us a little bit about what profit expectations are, and that's not looking good. Um, the recent reports on employment and unemployment have also soured. And so, and then you add on all of the chaos which President Trump's tariff policy implementation has caused. And I must say, as someone who pays a lot of taxes and never gets any benefits, um, President Trump has created circus like conditions in Washington, D.C., amongst all the bureaucrats and the media people and all of that. So it's been an interesting circus to watch. But I don't think it's been really great for entrepreneurs and investors, the people who hire other people and pay the bills and all the rest. So I think we're at a very precarious point right now in the economy. And I think that my prediction was just, which is typically the case, too early, too soon. I'm always expecting these things to happen faster than they actually do. But I think it's clear to me right now that markets are very upset, that they're not doing well. Gold is at an all-time high. Um, the commodity Bloomberg Commodity Index seems to be rising, and so all the numbers out there that I watch throughout the day, every day, seem to be turning, at least temporarily, in all simultaneously in a negative direction. So I think this leads into your concern about interest rates. If the economy does break and break hard, I think you can pretty much anticipate that the Federal Reserve will try to come in, uh, you know, uh, uh, to the rescue, so to speak, cutting interest rates. Now, just today, I was listening to Chairman Powell of the Fed, and he was saying everything is fine, everything is great. We don't anticipate having to cut any interest rates. We think we're going to stay the course in terms of returning to the 2% target. But they know, and we know, that they will react to cut interest rates and to try to, do the only thing that they can do, which is inflate the money supply in response to emerging crisis conditions. So this may take a while to become visible and tangible to the general public and the media. Um, there's signs, that they're showing a little sign of worries, but it's mostly about President Trump's tariffs and and the fact that he's announcing them and then delaying them and changing them and giving people breaks and delaying them and all that is creating uncertainty, and it is, but that kind of uncertainty is not going to cause a recession. It's not going to cause an economic crisis to start, but that's the only thing that they can focus in on because they don't understand the Fed and what it does to the economy. They don't understand the Austrian business cycle theory at all. They don't realize that there is a huge economic problem that is not of Trump's doing. This all happened under Powell and Biden for the last 4 years plus, um, and so it's a trap, and it's I think it's being sprung right now, and the Fed is a creature of habit, and when it sees a crisis, when it sees an opportunity to come in and save the day with lower interest rates, particularly with the financial stocks, the bank stocks not doing well right now, they've lost all of their gains. Like the some of the high flying tech stocks, the financials have lost all of their recent gains, and so that's what I'm anticipating looking forward over the next couple of months.
Mm. All right. So, if I could rewind a little bit,
Sure.
would you agree with my, well, a couple things. Well, I'll save that. Okay. Would you agree with my basic kind of thumbnail sort of history of the last little while here, where in the first Trump administration, essentially we were all due for a big crash from the bubble from the Obama QE and all of that they had done to make up for the last big crash in 2008. And so Trump was really desperate to put that off, and the Federal Reserve, I guess, was too. And so they were inflating, and he was desperate to get reelected. But then the germ came, regardless of how it escaped from that lab, and in effect, what happened then was because of the lockdowns, that sort of played the role of Paul Volcker in the 80s, jacking up the interest rates by essentially forcing a recession, forcing businesses to stop doing business and stop taking out loans and expanding the money supply that way, and sort of force the recession that way. But then they created trillions of dollars to bail out all big business, especially, but also everyone they sent checks to, and massively inflated the money supply again, sort of in a replication of QE. And so then that's the bubble that we're still under, the one that very late Trump won, handed to Biden, and Biden handed to him. And I guess with Powell's raising of the interest rates, they would claim that they succeeded in creating a soft landing where they had a big bubble, but they sort of tamed it down without popping it, which is what Rothbard says they can never do. It always pops. And then so it sounds like, if I have that right, what you're saying is, no, Rothbard's right. It always pops. And that's what we're coming up on now, is essentially the air has got to come out of the bubble. And so there's a correction due, and it's coming. But then one more wrinkle in that is it not the case that Trump is doing everything he can to slash regulations and taxes, and all that is very stimulative and good for business, but that just means they're going to take out more loans and expand the money supply even more by taking loans out of new money, right? And all that. So do I have any of that right? And where does that leave us?
Scott, you have it nailed, basically. And I couldn't agree more with you about the fact that when COVID hit, we were due for a big economic crash. There were signs, similar signs in terms of stocks and banks and employment statistics, which showed that as we were heading into late 2019 and early 2020, there were already negative economic signs, and the Fed had actually had to come in and do a couple of save the day type operations in 2019. So we were expecting a downturn, correction, crash, what have you, going into 2020. As a matter of fact, the Institute published a book where we have 20 Austrian economists, and this was published, I think, in April of 2020, saying, the next economic crash. So we were clearly and visibly, anticipating what would have happened. And of course, with COVID, nobody paid any attention to that, and that whole project went right down the toilet, so to speak. But of course, there is the possibility of the Fed, at least temporarily, bailing the system out uh, of an economic crisis with a massive inflation, and that's what Mises taught, and that's essentially what COVID allowed them to do. COVID provided cover for the Congress to spend multiple trillions of dollars and for the Fed to create, I think, $5+ trillion in money supply. So some things that we hadn't ever seen or even could anticipate, except for maybe with a massive war breaking out, were in effect covered up by the fact that we had COVID. They had to shut down the economy, so to speak. Everybody was going to die. You know the story better than anybody, and so with people glued to their CNN and staying at home, unable to congregate, and getting checks in the mail, and keeping the liquor stores open. I mean, it just completely shut the minds of Americans down and allowed them to cover over what would have been, in our estimation, some kind of economic crisis. And even at that point, if you go from the great financial crisis in 2007, 2008, and 9, and then you look at all the monetary policy, all the quantitative easing rounds that we went through, Operation Twist, and so on, where they were constantly feeding the economy and the banking system ever larger supplies of money, that we kind of anticipated it being a large economic crisis. And then COVID hit, it covered it all up. And of course, you don't know what was going on because all of that subsidy money and all of that Federal Reserve inflation made things like gross national product, gross domestic product, look fine. And of course, everybody knew that not many people were working, so it was understandable why we had so many people unemployed, and people were basically unaware of what was going on until that Federal Reserve stimulus started increasing prices like crazy, causing large scale price inflation in 2022, 2023. When we had to pay the piper again, so to speak, and of course, we still have those trillions and trillions of dollars of debt that, of course, never got paid off. And so there's a lot more pain and suffering through taxes, interest on the national debt, et cetera, that's coming due every payday, essentially. But that definitely is the case, that we were due for a crash. COVID had helped us avoid it. And there was not really, people lost their businesses, people lost their jobs, but it wasn't a business cycle correction type cleansing. A lot of commentators have noted in recent years that zombie corporations, which are so typical in places like Japan and Korea and China, are now we're seeing this more and more in the United States, where corporations stay in business. They can make their debt payments, but the companies are slowly eating themselves. Their balance sheets are shrinking, but they can make their payments with low interest rate in a low interest rate environment, where there's plenty of extra government spending going on. And then, we don't really know, of course, exactly the total impact of President Trump and his policies. Like I said, it's great theater. I mean, government bureaucrats getting cut, programs getting cut, uh, promises of deregulation, promises of drill, baby, drill. Um, you know, those are things that are promising. But I would note that, most states, individual states have regulatory systems which independently prevent oil and natural gas drilling and mining and some of the environmental issues that have been holding up American extractive industries. I write about this on my podcast this weekend, and and then there's all sorts of regulations. So they have a lot of work to do, and the benefits of deregulation take place over a long period of time. I mean, it
Right.
it certainly raises the spirits of entrepreneurs and investors, but the full impact of deregulation, like if you look at telecommunications deregulation under President Jimmy Carter, it didn't have much of an effect right away.
Yeah.
It took a decade to
And
really have its impact.
am I right to be so cynical and dubious about even how just because of the monetary system that then when times are good and banks are doing well, say they slash some regulations and not just banks, but I mean companies are doing well, that means that virtually always it means they're taking out loans to further their business, and that's new money, and that's always inflationary. Like just good times are inflationary necessarily because the monetary system is inflationary. So you're
Well,
really damned if you do and if you don't kind of thing.
it all depends on the Federal Reserve's policy. If the Fed is holding interest rates artificially low, then business people cannot make accurate projections of the future, and they might get lured into making investments which ultimately might not be profitable. And this is the problem with having the Fed in charge of the banking system and in charge of the money supply and in charge of interest rates. So, I mean, that this gets back to what you said right off the bat, is that, we need a Ron Paul revolution type undermining of the Fed's ability to control these things, and ultimately you have to get rid of it, either in fact or in reality. You have to take that power away
Mhm.
and make banks completely independent and completely responsible for the types of loans they make, and of course savers completely responsible for their deposits that they make in banks. So in a free market, depositors have to be insured of safety, and in a free market, investors and depositors and bondholders have to be insured, that the bankers that they're associating with are making good loans, and that is certainly possible. That there's no doubt about that.
Mhm.
But in the current situation, no one, and frankly, including Austrian economists, don't know if banks are making good, solid loans or if they're making artificially stimulated loans,
Yeah.
because you can't just match up the number that the Fed is discharging, and are they really increasing artificially the balance sheets of banks, or are they completely on the sidelines? And we
Mhm.
want the Fed completely out of the picture.
Now, so Mark, let me ask you this because I'm glad you had at least a chance to reference sort of offhand about the uncertainty caused by all this tariff policy. Um, but I'll have to do a whole interview with you about tariffs. on a different date because we're almost out of time here. But I wanted to ask you about this because I know that Robert Blumen and yourself were way ahead of the curve over at Mises.org in predicting the housing bubble and the housing crash during the W. Bush administration days. And as we all know, that was an absolute catastrophe. They call it the Great Recession because it was only second place to the Great Depression crash of 29, I guess. And then I was thinking about what you were saying about zombie companies there, and especially with the massive changes in social policy, forcing everyone to work at home and all that. Seems like every major city in America has got to have what amounts to now a massively overdeveloped downtown full of empty office buildings. And I just wonder, and Lord knows, I mean, I'm from Austin where the distortions are in great part driven by increased demand. But at the same time, it was all funny money that everybody was buying these houses with. And so prices in Austin, I know this isn't exactly a measure of the whole country, but prices for a house in Austin are way up. I mean, they're down a bit, but they're way up from where they were in 2019, 2020. And I just wonder whether you and Robert Blumen see a massive 2008 style catastrophe coming. And you say tech stocks already crashing, you see recession, but what about, something so bad John McCain would have to suspend his campaign over it, Mark?
Well, I think they all need to make sure they have plenty of diapers up there in Washington, D.C. And I communicate with Robert Blumen on a fairly regular basis, and we're just been biding our time. And I don't want to put words in his mouth, but I am certainly anticipating a severe real estate problem. And I think the first cracks will come in commercial real estate. And I've heard some commentary fairly recently, but in the finance sector. And I think this may be the reason why the finance ETF is down pretty noticeably just recently. And that is that refinancing these zombie office buildings is going to become problematic, and they're going to have to go on to the market. And the Fed has been cajoling these participants to suspend everything and to just push things off into the future, hoping that things would get better. And my understanding is that no, now today, that's no longer the case. And the holders of these mortgages are going to end up repossessing those properties and having to put them onto the market. And of course, if they do sell them, the values are going to go down and it's going to cascade
Yeah.
throughout this marketplace. So we're probably going to get a cleansing of the corporate, that corporate market this year. And then, of course, housing has been booming. And in my area, it still is. And the price of lumber right now is over $600 a unit.
Mm-hmm.
And that's really quite high, and indicating that right now, and that may be partly due to the tariffs on Canadian lumber, but that the housing, that they're building a lot of housing, that housing prices are really high, and there's a big gap in between what houses are going for right now.
Mm-hmm.
They're very high quality houses too, and multi-unit housing, and what the market will ultimately bear after a cleansing process takes place. So
Yeah.
yes, I do. I see all the sectors of the real estate market, the commercial, the residential, the multifamily. It's all going to have a significant and noteworthy down phase correction, and I think that's going to be led by all of the various segments in the commercial sector. And of course, office buildings are the lead force there because of just the social aspect of not going into work that you mentioned
Uh-huh.
at the beginning of your question. But it really, I mean, there's hospitals and there's storage units and there's all kinds of commercial real estate that may be overbuilt.
Yeah. I'll call it the skyscraper theory. Another variation on it, right?
Yeah, and the Jeddah Tower just got restarted after about 10 years.
Oh,
So
yeah. Well, I thought of you too when I was watching this thing that YouTube, I guess, had just fetched up for me. This guy, I've seen a few of his videos where he talks about, and he's looking at the economy through a soda straw. He's not Austrian, but he's saying, look at how absolutely ridiculously expensive these pickup trucks are. And look at how long they're staying on the lot. And the typical turnover is this many weeks. And these trucks have been sitting here for this many months and they can't get rid of them. And this huge thing is run on a four-banger that's like the EPA mandated the design of these ridiculous things. And nobody wants them. It just a Ford for a 150, F-150 can be upwards of $100,000, like especially the higher end pickup trucks it's just absolutely completely out of control. And this guy, he's talking about, damn Detroit, they are, trying to extort us into these, massive debts for these vehicles and whatever. But I could imagine your Austrian style thinking behind, what's really going on with those markets. And then, but what does that really signify too, when they can't get rid of these trucks right now? And I think I had heard that, people overall are behind on their car and truck payments in very high numbers. I don't know if that amounts to a crash, but I know there was a huge bubble in especially used cars during the pandemic and all that. During the lockdowns, I should say. It wasn't the germ, it was the government policy.
Yeah, that goes hand in hand when people are making money in construction and real estate, and when houses are going fast, and of course the truck market was that way certainly last year. It's just it's slowed down, and the prices are just ridiculously astronomical. And Scott, I would point out, if your listeners want to tune into a positive opportunity, my podcast tomorrow on minor issues is going to be on extractive industries, mining, oil, natural gas, and why there may be some long-term opportunities in that area that it's been smashed by regulation. It's been smashed by the global warming ideology, and and people not wanting to get into dirty industries. But it's really a cool industry that's turned extremely high tech with robotics and autonomous vehicles and all sorts of technology. And I think it's going to be an interesting, uplifting story that we're going to see over the next few years. So while most areas are going to be in a downturn, I believe, this is one area, bright spot in the U.S. economy, and really not just in the U.S., but around the world.
Yeah. Well, Mr. Right about everything all the time, Ron Paul buys gold. I don't know that he goes around telling people to buy gold, but I know he buys gold. So
well, he's looking pretty smart again.
I know. I'll tell you what. Okay, well, listen, I'm so sorry that I'm out of time. I wanted to ask you all about tariffs and things too. I know there's a lot there, but it's been great to catch back up with you, and I hope we can do it again soon.
Me too, Scott. And tariffs are going to be around for a while, so have me back on.
Absolutely. All right. Looking forward to it. Thanks a lot. All right, you guys. And that is the great Mark Thornton. He is at the Mises Institute. That's the Ludwig von Mises Institute at Mises.org.